Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. I'd like to offer you some charts today, and the first one I'd like to look at is the euro against the dollar. Okay, as I've recently said and written, it is comforting to note that after a few weeks on vacation, I can come back and see that the same patterns I'd highlighted before my break were still in operation. Specifically, the diamond bottom formed over March and the subsequent bullish halfway hesitation. Indeed, not only are they still in operation, but last Monday they all reached their various targets. Yes, those ones I've been droning on about interminably. The initial target X for the diamond bottom in the 116.75 area, as well as target X3 in the 116.60 area for the subsequent bullish halfway hesitation, and finally target X2 in the 117.25 area. That was the optimized target for the diamond bottom. I'd just like to again note that some of these have been on my slate since the break upwards back in mid-May out of the diamond pattern. The question now is, what's next? For that, I'll leave to a little later once I see the action here. However, I do note the way the market has wonderfully stalled after reaching all those targets. Plus, we do have the big 2011 to date downtrend currently at 118.31, running down just a little overhead, as well as the highs from September 2018 at 118.17 and June 2018 at 118.51 nearby. So for the moment, nice moves euro dollar, very nice. Next one I'd like to look at is cable, aka sterling against the US dollar. A fourth bullish white soldier yesterday with a new high close, not seen since March. Today we're seemingly about to edge higher still. The market has moved out of the consolidation phase over the long moving average, currently 127 even, and is attempting, even slowly pushing through the congestion from February this year between 129 even and 130.5. Overall, the market is moving up nicely within the May to June bullish Andrews pitchfork, specifically between the lower time, currently 126.89, and the middle time, currently 130.95. Yesterday, the market punched up and closed over the weak-looking upper channel line from April to May move, currently at 129.53. Today, it seems to be using that as support for further potential moves higher. The next chart I'd like to look at is euro against sterling. A small bullish white soldier yesterday that tried to reverse the previous session's countering bearish engulfing pattern, but got stuck between the big 50% Fibonacci line for 2020 overhead at 90.85 and the short moving average below, currently at 90.48. Today, we've again punched down through the short moving average, but we'll have to see if the market chooses this time to close below it. What is interesting is that just below this and rising could be the additional support of the short stroke medium moving average, currently at 90.03. This has been quite good support in the past 2 months or so, so watch out. The next chart to look at is the US dollar against the Indian rupee. A possible hanging man pattern there, almost a key reversal up yesterday. Hanging man patterns are typically seen as bearish. However, data suggests they tend to be bullish continuation patterns about 60% of the time. This comes after the previous session's bullish engulfing pattern, and it still goes against last Friday's bearish dark cloud cover pattern. The overall market still seems to be channeling lower, but with the previous early July low on the lesser Fibonacci level at 74.46 not that far away, it's perhaps not unexpected to start to see such action. We also have the late March low at 74.35 just below that. All that being said, no definitive pattern seems to be standing out in recent times, bar a possible but perhaps unlikely small double bottom. The final chart I'd like to look at is the US dollar against the Brazilian real. A bullish white soldier yesterday, which acts as a counter to Monday's bearish black Maribosa stroke bearish engulfing pattern. These actions are further concerns that this market has about what it should be doing. It's no idea. Should it attempt again to test the overhead neckline currently at 522.88 of the small, unfulfilled, reverse head and shoulders pattern formed over late May to late June? Or should it follow the bigger picture of a bearish bump and run reversal pattern formed since March? In such a situation, I guess it ought to be no surprise that the market is forming contrary patterns with short intervals in between. So that about wraps it up. So stay safe in the markets and in real life.